Hello, everyone. Welcome to our webinar today, The Resilience Factor, How Investors Assess Climate-Ready Governments. This is a joint webinar of the Center for Climate and Energy Solutions and the Vermont Bond Bank. I'll take a moment to give some introductory remarks here and then introduce our panelists for today. Sort of format will be that we will have our panelists provide some comments on the subject, and then we'll have a discussion, and then we'll field some Q&A from the audience towards the end of the event. So to start things off, I'm Michael Gaughan. I'm the Executive Director of the Vermont Bond Bank and will serve as moderator for today's discussion. The Bond Bank is one of thousands of issuers in the municipal bond market, and it's a little instructive to understand our background to get familiarity with who we're talking about today. We are a public instrumentality of the state of Vermont with a purpose to provide access and low-cost capital for units of government around the state, which are mostly small rural communities. We do this by pooling local loans together, credit enhancing the structure, and then selling larger bonds with economies of scale into the municipal bond market. We were the first bond bank in the country in 1970, and while we have a large audience here on the webinar, I will shamelessly plug the fact that our board will be considering our summer bond issuance tomorrow at our meeting, and you can find more details on our upcoming bond sales at vtbondbank.org/investors. As described in this title, this webinar will explore the connection between the $4 trillion municipal bond market and new approaches to climate risk evaluation in financial markets. Over the past 10 years, municipal bond issuances, or municipal green bond issuance, has grown from $3 billion to over $20 billion per year. Despite this growth, most of the discussion on green bonds has been centered around the environmentally friendly construction of the projects versus the ability of communities to adapt and withstand the financial challenges related to the physical impacts of climate change. This dynamic is changing rapidly as investors have become empowered by quality data that sheds light on the long-term risks related to flooding, wind, fire, and heat, while also bearing witness to the devastating consequences of environmental risk in places like Paradise, California. This new avenue of credit analysis, however, has the potential to add yet another layer of darkness to a market that struggles with transparency. In particular, for issuers like the Bond Bank, questions exist on how hyper-local climate solutions and financial policies can be incorporated into a data analysis that is based on national or even international climate data sets. Here to explore this topic with me today are Amy Bailey, Director of Climate Resilience and Sustainability at the Center for Climate and Energy Solutions; Evan Kodra, Senior Director, Climate and ESG at ICE Data Services; and Erica Small, Research Analyst at Breckenridge Capital Advisors. Before jumping into our discussion, I did just want to take a quick moment to introduce many members of the audience to the U.S. municipal bond market. First, what is the U.S. municipal bond market? In short, this is where the day-to-day infrastructure of this country is financed. Unlike other countries, we've chosen to decentralize infrastructure at the state and local level and subsidize the borrowing rate by making it generally exempt from income taxes. Historically, around 70% of state and local construction was financed through the municipal bond market. For comparison's sake, the IIJA, or Bipartisan Infrastructure Law, represents a historic investment, but includes total new spending equal to $550 billion over the next 5 years, versus around $620 billion in bond issuance over the last 5 years in crossover categories or sectors like transportation and utilities. Traditionally, a unit of government like the Bond Bank puts together a financing team and then talks to rating agencies to receive a credit rating that translates risks to investors. This includes things that would be expected, like the entity's financial position, but also social indicators such as community wealth, housing cost, age demographics, and other factors. As you might expect, a natural tension exists as climate enters the discussion, as the very improvements needed to mitigate climate will be financed in the muni market, and issuers may become even less likely to finance needed improvements when and if a climate risk premium takes hold. To establish the baseline of data involved in this emerging area of analysis, we turn to Evan Kodra. So Evan, I'm going to hand it to you, and to start things off, what does the emerging landscape of data related to physical risk look like for municipal bonds?
Cool. Thank you, Michael. Yeah, it's a great question. So I will show a few things, but first let me back up a step and talk a little bit about where I'm coming from and how I got here. So I had started a company along with other co-founders back in 2016 called Risk with a Q. Some of you in the audience may be familiar with this company already. End of 2021, we were acquired by Intercontinental Exchange. So that's where I'm at now. We're still doing a lot of the same types of work focused on the municipal market, as well as other interrelated markets, including the mortgage market, for example. Sort of the history of how we got here. We started off looking at climate change before there was really a climate risk industry that there is now. With the broad concept that bringing climate risk into the private sector was going to be important if the world was going to adapt and actually deal with climate change. Of course, now zooming forward, as everyone here probably already knows, this is a huge topic in the private sector now. So that landscape has evolved. To answer your question in short, the landscape has evolved in a huge way. We started with an idea of focusing on the insurance sector, or the insurance and reinsurance and broadly speaking risk transfer sector, with a thought that, or with the hypothesis that if you could help the insurance sector factor climate change in, that would be a macro way to help the financial system adapt to climate change. The long story short there was for a whole bunch of reasons, but primarily boiling down to a time frame issue, and an incentive, and basically a structural incentives issue. The insurance market writ large doesn't really have an incentive to bake climate change directly into the models that they use to then price premiums and make decisions around what to insure, how much to insure it for from a premium basis, and whether to insure something. I'll come back to that shortly, as it has a lot of implications for the municipal sector. What we basically figured out was there is a so-called insurance gap that has created and continues to create indirect pressure on municipal budgets through pressure on either sort of general economic activity around or within an issuer's boundaries, or via the potential, at least, of depressed property value that of course is commensurate with taxes that are used to service debt. So starting in around 2018, we essentially rebuilt what so-called catastrophe modeling companies do, which is now called physical climate risk in today's world, but adapted that to serve primarily, at least start with the asset management side of the municipal market. And over time, we've seen that sort of the adoption of these types of frameworks and models increase quite a bit, at least on the creditor or asset management side of the market. Most or many asset managers are looking at this stuff now. Our theory of change, so to speak, in founding founding and building this sort of idea, was originally that, look, if we can get the asset management or the credit side of the market to realize that climate risk is a growing sort of hidden problem in the municipal market and creates sort of a systemic risk that going unaddressed is going to be problematic, will eventually lead towards incentivizing the issuer side of the market writ large to do something about climate. And doing something about climate in these terms, to your point, Michael, earlier, that most of the infrastructure locally in the United States is funded via municipal debt. Adaptation, it follows sort of logically that adaptation would be funded largely through municipal debt, through the issuance of climate bonds, et cetera. And so we're starting to see that happen. I can get into more examples later of where that's happening, but there's definitely an opportunity for that to grow a lot in terms of the amount of demand that there is for municipal debt in general, but also especially for like green bonds and climate bonds and all those kinds of things. I'll walk through a couple of these things just to give everybody a sense for how I at least currently think about what climate sort of means, and trying to wrap it actually inside of ESG to dispel, at least from my point of view, dispel the notion that climate and so-called ESG are actually separate. So in the municipal market and generally in fixed income markets, so including the mortgage market or other debt-based markets, the entire premise of the market basically depends on the stability of the underlying assets that you're dealing with, right? So at property values. If you actually look long-term enough at what climate change means, it could completely upend this paradigm. And so when I actually think about that from an ESG point of view, you can kind of break it down in terms of like, well, what could ESG really mean when you're thinking about this? So environmental essentially covers climate change, right? So climate is and will continue to, and given the path that we're on, this will likely accelerate, is really going to dramatically reshape our world, dictate what is livable in its current, by its current form. And as a function of that, will eventually alter asset values, liabilities, and the viability of different patches of dirt around the United States or around the world. So, of course, often we talk about climate as if it's in isolation from social processes or economic conditions, but that's not true. So when we look at this problem, we look at socioeconomics and governance as if, and this is true, they are inextricably linked to climate, in the sense of there are communities all throughout the US who will have an easier time adapting because they have, frankly, the access to resources and the wealth to leverage the municipal market to actually borrow capital to fund climate resilience. And governance structures is an interesting one, but you could think about this as the willingness and ability of in this case muni issuers or states or cities, et cetera, to actually respond on behalf of their stakeholders. So for the simple example would be, is there a climate action plan in place, and how realistic is that climate action plan, and how well is it tied with whether or not there's going to be financing available to actually do something about climate. So next slide, please. Yeah, and there's a button you can press that will play this video, but the point of this video is just to get a real sort of more visceral sense for how extreme climate models are projecting pervasive conditions like drought or heat stress could get. So we know that right now there's a whole lot of water stress risk out in the Southwest US. And if we believe to some extent in climate model projections, this is of course one of the worst case, quote unquote, worst case or business as usual scenarios that the International Panel on Climate Change relies on. So we may not see a future that's as bad as this, but right now we're on track for that. And I think it's instructive to look at worst case scenarios rather than be optimistic and undershoot how bad things could be. If we kind of have a sense for how bad the drought conditions have been in the last 10 years, imagine how bad this could be if we're zooming 20 to 30 years out, right? So oftentimes there's a focus on the sort of acute climate shocks like hurricanes and floods and wildfires, and those are super important, of course, but if equally and if not more concerning for the municipal market, which again relies on this idea of the stability of asset values and liabilities, when we're talking about phenomena like heat stress and drought, which are almost all climate models project, and the details can vary, but that they'll project that these things are permanently going to get worse, and to the extent that those things are already sort of baked in over the next 20 years, we really have to start asking hard questions about, okay, so when could certain portions of the US be unlivable by current definition? And if so, what are the consequences of that? So next slide, please. Yeah, so we don't have to necessarily belabor the point, but this is heat stress, and we're just showing a similar type of dynamic. It's a little bit mirrored across the US. Again, when will it get so hot that we don't have the ability to respond. And these are uninsurable types of risks, right? These are risks that if it gets hot enough to where you can't live in a certain area, there is no insurance mechanism, even if the insurance markets were to start responding to climate change. So how do we deal with these uninsurable risks? How do we think about the assets that we have? How do we proactively get ahead of this as a market and respond before it's too late, and then we have correlated risk that we can't deal with as a market? So there's plenty of opportunities here as well. Next slide, please. Yeah, and this is just sort of, I'll wrap up with this one, but this is a quick and dirty slide to show that, look, there's things like drought, there's things like heat stress, and then there's other things that we're less certain about in terms of the analytics around water stress. And so water stress takes into account not only in this example, takes into account not only meteorological drought, as it were, but also looking at the demand side of water. And obviously we see in the Western US that is grappling with this right now in terms of figuring out mechanisms to incentivize more sustainable water consumption. But this is going to play a huge role in how the future of the West develops, as well as how viable municipal credit actually is over the next 20 to 30 years as this progresses.
So thank you, Evan. I think what we saw there was there's obviously some really robust data sets, and there's interesting questions that emerge as to whether some places as a result of climate change are binary in terms of the risk that is acceptable, or the ability of those places to frankly sustain, sort of contemporary life. But then there's another question as to whether, as is often the case, governments can be agents of their own destiny, that they are not necessarily subject to, and this is borrowing a term from Evan, but environmental redlining, that they can actually respond to these problems, that they can, develop desal, whatever it is to ensure the survival of their community. And so to talk about the way in which governments can develop a framework to think about climate risks and opportunities is Amy Bailey. I think, Amy, to start you off, Evan said two really interesting things. One, he said that there are, potentially uninsurable risks. We know that government deals with market failures. And then also he said that the municipal market depends on the stability of assets. It's always relied upon the stability of government, and they are stewards responsible for these public assets. So with those two things in mind, how can a local government or state government think about climate risks and opportunities from a financial perspective?
Great. Thank you, Michael. And thank you for everyone joining us today. Just a little bit of background about C2ES. We are a nonprofit climate think tank working with a variety of stakeholders to advance the global net zero transition to a climate resilient economy. You can go to the next slide and go ahead to the next one after that too. So climate resilience is, probably no surprise, a major pillar of our work. And from our perspective, before I get to Michael's questions there, two things are true. We think that thriving communities must be able to integrate climate resilience and equity into their decision-making, and that public resources must be effective, accessible, and robust in order to ensure that resilience is happening in our communities and businesses as well. So our resilience work has really focused on filling knowledge gaps for local and federal decision makers, and also to foster collaboration between the public and private sector. In the case of this conversation, I mean, we're really drawing on our experience on the financial risk issue within the private sector, and then applying it to this local level to really help improve decision making and strategic planners at the local level. So there are conversations on this issue happening in many corners, but the conversation is largely in early stages. So the folks on this call are, it's a good time to start thinking about this. We released a primer early this year to lay out some of the foundational components and help translate the issue for the local context. And I do want to thank our supporters at Bank of America for making that possible. Next slide. I want to start by kind of exploring, what do we mean by climate-related financial risks and opportunities? I think Evan has kind of started laying out a little bit of a view of kind of what the context might be, but This graphic here is from the Task Force for Climate-Related Financial Disclosure, and I think the image is really applicable to the public sector. So I want to just quickly point our attention to a few key elements and frame the conversation. So the graphic shows how different climate-related risks and opportunities can be fed into the strategic planning and risk management activities, and understanding the potential financial impacts on an organization's fiscal health and performance. So for the purpose of today's conversation, I want to highlight two areas of interest. So there's the physical risks associated with acute and chronic climate hazards, like Evan was just speaking about, sea level rise, extreme weather, seasonal changes. But there's also opportunities related to climate change. So that can include benefits from a host of actions like resource efficiency, investing in resilience, and more. And so I think it's important to look at kind of both sides of the coin here. We'll talk about these more in just a few minutes, but I do want to note there are impacts associated with the transition to a low carbon economy, and those also lead to financial risks and opportunities. They're also there on that graphic, but we're not going to focus on that too much on today's conversation. So information about these risks and opportunities, I think in many places are already being integrated into decision-making processes through vulnerability assessments, climate action, adaptation plans, and even capital investment decisions. And that's a good thing. Where we're seeing increasing systemic interest is thinking about how these risks and opportunities really translate into a financial impact for an entity. And for this, we need to think about components that contribute to the fiscal health of municipalities, like public assets, government operations, capital investments, and then on revenue streams and funding sources, and of course, assets and liabilities that sit on the balance sheet. So with that kind of in mind, I want to take a little bit of a deeper dive into the risks piece before jumping over into opportunities. I guess, no surprise, it's important that we all understand that climate hazards can have impacts on public assets and operational expenses. And in our primer, we started kind of listing out some of the details of where that might show up. But I think we all can kind of understand that when extreme weather event hits, local governments are going to have to spend some money to address a variety of immediate needs, cleanup and recovery, short-term and long-term needs as well. But I should point out here that not all financial impacts happen after an obvious disaster event. As Evan was kind of mentioning, some of these are chronic impacts, so they're a little bit slow moving, or they have impacts down the line. So a working paper out of the Federal Reserve Bank of Boston recently found a 1 degree Fahrenheit increase in average temperature was resulting in a 3% increase in per capita total general fund expenditures, also increased public works costs. So these things are kind of starting to pull a little bit more on government budgets than maybe we're all kind of aware of. Of course, climate hazards have implications for capital expenditures, and some of that obviously intersects with the bond market that we're talking about today. Whether this is, necessitating new infrastructure or presenting upgrade needs, even creating needs to move or relocate public infrastructure is all part of the realm of possibilities here. And these are all increasing expenses that the public sector is going to need to manage for. As the investor community and the credit ratings agencies are taking a closer look at climate risk and how issuers might be able to repay their debt, naturally, there's a growing potential for the cost to borrow to rise as a result. And I'll just point out one more piece on this list here. Of course, on the revenue side, this is something we don't necessarily think about as much, but there are financial risks from extreme weather events here, or even sea level rise. We're thinking about revenue from taxes, public service revenues, and the like. And so a couple of things that we've seen, studies have shown that after a hurricane, tax bases can drop over time. And another factor that we're watching play out right now, Evan mentioned the insurance industry and where decisions about homeowner policies might impact the broader community. that can have indirect impacts on a public entity if livability falls, and that might start impacting the property tax base of a locality. And I think it's useful to note here that identifying and quantifying these risks and impacts is not necessarily an easy thing. There's near-term impacts associated with response and recovery, and those might be pretty easy to quantify. But longer-term impacts might also play out over many years and become harder to associate with an event or a specific hazard. There's also direct and indirect impacts where some climate-related impacts will fall directly on the government, whereas others are kind of more directly hitting, members of the community and then indirectly impacting the government organization. So these considerations can make it really difficult to get a full and clear picture of a bond issuer's financial risk, but I do pose that there can be a lot of value in gaining even just a slightly better view, and we can talk about that later if the conversation goes there. Now, moving over to the opportunities piece, I think it's important, as I said, to note that there's two sides of the coin here, and there is a positive direction that a lot of communities can be starting to move towards. So opportunities that can arise from climate policies, new technologies, adaptation measures, those can all improve a bond issuer's fiscal health. And I think there's two kind of components that I just want to mention. First, there's an avoided cost story here. The more you invest in adaptation measures, the more you're mitigating your future damage. And so avoided costs, longer useful lives of assets is naturally, it's a good thing from a financial perspective. There's a number of figures that are out there that show that proactive adaptation is more cost effective than post-disaster recovery and adaptation. And so there is something to be said for getting ahead of these impacts. Also, I think something exciting to note is there's a lot of resilience opportunities to bring more money to a local government. So governments that are thinking about their adaptation needs are going to position themselves to access state and federal dollars. They can take steps to either protect their revenue streams or service revenues, but they can also take advantage of green bonds, climate bonds that are attractive to a lot of investors. And finally, I'll just note a couple of resources here on the right. Not to be forgotten, there's a lot of new grants and resources that are being made available through 2021's Infrastructure Investment and Jobs Act. And there's also a lot of really interesting grants and tax credits that are being made available through the Inflation Reduction Act passed last year. One thing I'm very excited for is a new provision in the Inflation Reduction Act that is giving local governments a chance to directly benefit from investment tax credits. That provision is going to put more climate mitigation and resilience projects in closer reach to a lot of local governments. C2ES is working with the U.S. Conference of Mayors on a paper to come out on that soon. There's also non-governmental resources as well. I'll just note here the Resilient Community Development Finance Initiative, which is really designed to help impact investors and CDFIs to start making loans that are really integrating resilience into their design. And so I think that's an exciting place to watch. And the last piece is the disclosure piece. And I think that's where Erica will come in. Really what kind of information is being shared. And there are now more pathways for local governments to start sharing that information in kind of a common platform, either through CDP. I know ICLEI's helping out with some of those pieces as well. So I'll stop there and turn it back over to you, Michael. Can't wait to hear Erica's comments.
Great. Well, thank you so much, Amy. I think Amy hit upon a couple of really interesting ideas. One is just that the risk is hard to quantify. And so as we turn to our investor on the call, Erica, whose job it is to understand this risk, how are you looking at local climate risks and opportunities? We heard from the public sector. Now we're sort of looking at the private sector and the buy side, integrating some of Evan's data. I'll give it to you, Erica, to tell us more.
Yeah, thank you. Happy to be here. Thanks for everyone for joining and for the C2ES for putting this on. So you can go to the next slide here. So yeah, I'm Erica Small. I'm currently at Breckenridge Capital Advisors. So we are a large, high-grade fixed income shop. We're based out of Boston. I think our numbers are around 44 billion under management, and over 80% of that are in municipal bonds. So I'm an analyst on the municipal bond investment team, and my job is to perform credit analysis on all the bonds that we currently hold, and those that we might buy. And then in addition, I do a lot on ESG work. Next slide. So I guess I just wanted to pause here before I get into what I do at my job right now and provide a bit of an investor perspective. I do want to give just one, I guess, sort of anecdote from my background. So I don't come from finance. I come from engineering, policy, and academia. And I do just want to say on this topic that those experiences, that set of experiences, has made me fully appreciate just how difficult it is when we're talking about infrastructure, design of infrastructure, planning for infrastructure, and climate change. So I was a water resources engineer out in Colorado for several years before doing a PhD on the topic of how we pay for water in the United States, which is largely via municipal bonds. And the problem with so much of our infrastructure, although there are some flexible solutions that are now being talked about and some new innovative designs, in general, when it comes down to actually designing and constructing a road or a water system, putting in a new building for a school district, you name it, all the local infrastructure initiatives, in general, you have to pick a design and pick a design event that you're accounting for, whether that's the 100-year flood event or the 500-year flood event, or a certain water capacity, et cetera, and actually design it. So what I mean is that it's really hard to actually design a fixed infrastructure that in our country is largely made of something like concrete, to be really climate resilient under an uncertain future. And that background sort of makes my job now pretty interesting. Next slide, please. So Breckenridge has been doing a lot with ESG long before I was here. In 2011, so now we are over a decade of this. In 2011, we formally started implementing ESG research into our credit analysis. So what that means is that right now, and for the last 11 years, every single time we look at a bond, whether or not we own it, we do an issuer-specific bottom-up ESG analysis. And we are an ESG integration shop, meaning that we're looking at ESG data and metrics from a company like Evans that is a part of this holistic risk assessment. So we do perform traditional credit analysis, sort of similar to what the credit agencies are doing, but we complement that with pretty significant focus on various ESG factors, and in particular, a lot with physical climate risk and transition risk. Next slide, please. So in the municipal bond market, is really interesting because it not only is a very large market, so we've been around $4 trillion for several years, but it also has over 50,000 individual issuers from a broad range of sectors. So it makes it pretty idiosyncratic, and it means that the way that you analyze climate risk from an investor perspective has to be somewhat flexible. That's why we like to do this bottom-up analysis. It doesn't really make sense to be looking at something that's a water sewer bond the same exact way that you might be looking at a tax-backed GO bond, the same exact way that you might be looking at a hospital. Also, across different regions of the United States, some climate risks are more or less pertinent. In some areas, transition risk is a big deal. In other areas, it's not as big of a deal. So we have different frameworks for every single sector that we buy and analyze. And when I say frameworks, I mean bottom-up ESG frameworks that we build and maintain. And we are constantly updating those as we learn more and more about what are the actual ESG factors that could impact the different sectors in the municipal bond market. Next slide, please. So before I get into this particular slide, I do just also want to remind everyone on the call that the municipal bond market is, I think, broadly considered to be the market that's on the front lines of the climate crisis in the US. So obviously climate change is going to affect really every market out there, including corporates, including equities, et cetera. Obviously, it's going to affect and already has affected sovereign bonds. But in the US, the municipal bond market is on the front lines in the sense that the municipal bond market is the tool that is funding the vast majority of our country's local infrastructure. So I think depending on what type of infrastructure you're looking at it, it's more or less, but I usually quote that it's somewhere over 70% of our country's local infrastructure is funded via municipal bonds. So the market is therefore the primary tool with which we're funding that, and therefore is the primary tool with which we will be investing in resiliency or disaster recovery, et cetera, and already has done so to a certain extent. So this slide, I don't really want to spend too much time on this, but this just shows as an example what we do. So let's take a hospital, for instance. So for a hospital in this sector-specific municipal framework, we're going to look at a variety of metrics, including physical climate risk and transition risk. And then we will roll that up into our own internal sustainability rating, which then kind of determines if we could put it in sustainable portfolios, but also can then actually change some of our internal credit ratings. Next slide, please. And then, yeah, the sort of last thing here is just explaining a couple different metrics we might look at for different sectors. But I think that for the purposes of this call, I want to focus on the point that although investors are looking at this, which we are and we have been, when we look at the market in general, and we have looked at this statistically, this was something I looked at in my PhD. I know other colleagues have done this as well. The market is still not pricing in climate risk. So while this is something that has certainly gained traction, and that I don't think ESG is really going anywhere, even though there is some backlash. We're not seeing a pricing signal for climate risk in the municipal bond market. And that's a problem for a lot of reasons, but also an opportunity in the sense that if you are an issuer right now that has access to the municipal bond market, you can essentially do things to shore up your climate readiness, perhaps with no additional yield penalty. And that is something that I hope issuers who are listening can maybe take home. So I will leave it at that for now.
Well, Erica, thank you. I think you kind of jump-started one of my first questions, which is how or when will the market potentially price in climate risk? From your research and from that of others, it sounds like it isn't, but there's an opportunity there, both for you in terms of value add to understand the places that will be best positioned to sustain that potential risk, but also issuers to issue. And so I think I'd like to take one moment. Oftentimes on these sort of market calls, people talk about issuers as if they aren't in the room. So I am an issuer, I am in the room, and we have kind of an interesting perspective in that the bond bank is both a portfolio manager in terms of our loan pool, as well as an issuer. And so, one of the things we're thinking about is, just like everybody else, what is risk? How do we get our arms around that? But also responding to some of the things that Evan, Amy, and Erica said, which is that the impacts of climate change are disparate. It's different in different places. Credit analysis is bottom up, which another way of saying that from the investor side is that it's expensive and that you may not necessarily lend it to your very small deals. And that also the responses that Amy talked about are idiosyncratic, and they take a lot of explaining, a lot of understanding. So we as a bond bank play a really interesting role connecting all these in that we have diversification within our portfolio because we cover the entire state. So while there is drought conditions in the northern part of the state, that's not necessarily true in the central and southern parts. We have experience with credit analysis at a hyperlocal level. Our median community in Vermont is 1,800 people. Our smallest borrower is 600 people. And so we can tell that story when we go to talk to folks like Erica about what these highly idiosyncratic small responses are at an aggregate level, because we know our borrowers better than anybody else, because that's what we do day in and day out. And then finally, we can sort of homogenize this risk by extending the credit enhancement that we have from the state of Vermont. And so not every place is going to have the same willingness as Vermont. Not every place has a climate action plan with a adaptation and resilience chapter. But what they do have is the threat that their communities will be unsustainable. And so, kind of advocate here in terms of responses for the way a bond bank or pooled loan issuer can help navigate this emerging credit landscape and provide favorable outcomes. We also, at a lot of the time, since we're offering access to capital, we're the stick or the incentive, depending upon your perspective, to shape up so that you can get capital from us. And the same might be true of instituting a response to climate change. While we're on the subject of government responses, I would also just take a quick moment here to plug work, and some of my colleagues are on here from GFOA Standing Committee on Economic Development and Capital Planning, where we're working on, I guess, a white paper or something. I don't know what it's going to be called, but articulating why the capital plan should really house a lot of government responses to climate change. We heard a lot about capital. We also heard about capital needs that are unpredictable. So capital reserves become more important as a mitigation of risk. And these things are long-term in nature. And our capital planning document is the place in the government budget that most oftentimes is looking towards the future, and best practice from GFOA is a 20-year capital plan. So with those sort of government responses in mind, recognizing that bond banks are unique and they have a role to play here, did just want to turn back to how big data approaches that Evan has sort of highlighted and Erica uses in her day-to-day work can meaningfully absorb responses like we see in our communities here in Vermont, so that we're just not painting everyone with a broad stroke, and that we can actually understand adaptation responses, and to the extent a risk premium emerges, properly reward those who have taken the right measures. So maybe to start it out, Evan, like how flexible are the data sets to incorporate some sort of unique locally based data?
That's a good question. So we do things like, for example, if we're aware that and there's pre-existing data on, say, flood defenses, those get integrated directly into the ways that our model works, and then scores and metrics underlying that would modulate and be reflective of that. In many cases, if there's smaller examples of this, that's something that we're unaware of. It might not, it wouldn't get flushed in through our model, and we wouldn't have those metrics available because we don't know. That being said, we're always our mentality is always about encouraging issuers to get involved and engage with this kind of stuff. And if there is something like that, we would love to be challenged on what we're saying. Another sort of angle on this is, so we've done some interesting work looking at cost benefit analysis around adapting to climate risk for an issuer around the city of Boston. And that's something that it's a sort of a deeper analysis based on looking at hypothetical investments in defenses, and requires sort of digging deeper than just using our platform straight out of the box. But it can be done relatively easily. And in my mind, it could be used to sort of fuel the justification behind investing. So if you're looking at the potential capital costs, and this is sort of reflective of some things Amy was saying, like you're looking at the estimated capital cost of an investment. On the back end, what we can do is look at, well, how much expected property value loss, GDP impairment losses would be averted because of that, and then sort of amortize that over the for example, the lifetime of a hypothetical bond that would be used to pay for it. And then yada, yada, yada. There's just like a win-win-win for everybody. So there's a real life example of this that I would encourage everybody to look up, which is with Virginia Beach, which did exactly this. They issued a bond, the voters approved a bond, I think it was at the end of 2021, for a little bit more than $500 million to do exactly this. And underpinning that was a bunch of work done by I believe it was Old Dominion University, looking at a cost benefit analysis in a somewhat similar way. I think there's a big opportunity for the muni market to take that and that kind of broad idea and rinse it, repeat it in a faster way, because we're going to need to, frankly, we're going to need to be deploying these types of projects at a much bigger scale over the coming decades, without having to sort of reinvent that analytic wheel each time.
So for Erica, what's your response to that? How much can you modify the data you're looking at? Because there's certain types of disclosure that helps you get to that point in terms of coming up with your climate-related risk rating.
Yeah, so I think the data that we get from the ICE team is pretty excellent data in general about when it comes down to good issuer-specific climate risk data. In terms of it, but that's certainly not where we stop. And I think that in terms of additional data, that really just comes down to the level of disclosure that we get from an individual issuer. And that can really vary very widely. We only operate in the high grade space. So I would say in general, it's rare that we find absolute, zero disclosure on climate risk, but it does still happen. I personally don't like to constantly be walking around saying issuers need to do more, because I think that investors need to do more too, and it's asset owners need to do more, right? It's not just up to the issuers. But one thing that we really like in terms of, trying to personalize climate risk and really get a true understanding of its impact for a particular location in the United States, a particular issuer, service area, et cetera, is kind of in line with some of the stuff that Amy laid out in her primer and in some of those slides. And kind of the gold standard that we see, or that we currently walk around with, sometimes hoping we'll get, and we do get sometimes from some issuers, is breaking out climate risks and then tying them directly to what your capital improvement plan is doing. So saying, okay, we know we have high water stress, and this is how we're addressing it in our capital improvement plan. And this is how much it will cost. A next step, which I guess we're sort of seeing some issuers begin to do, is exactly what Amy laid out, which is then saying, okay, we know we have water stress. This is how much it has cost us in terms of operating expenses. This is how much it could potentially impact operating revenues on any given year. For example, like if there's water restrictions in place and your sales have to be lower if you're a water utility. And then this is how it's actually could impact our tax base if unaddressed. And then there's a bunch of other things that I'm not mentioning, but those are the ways that I think climate risk is something that becomes most useful for an investor in the municipal bond space, is actually tying it to the impact on your balance sheet, your cash flows, and your statement of revenues and expenditures.
So that's interesting. What I'm sort of hearing there is like, put your response in a really obvious place. So rather than it be hidden in a plan or a project that isn't publicized, you somehow incorporate it into your financial disclosure rather than, separate disclosure in a way. Amy, one, and this comes from the audience, but it is as a natural fit with this discussion, is, in thinking about your work, obviously we have some places that are very attuned to this particular risk and others that aren't, or might talk about it in different ways. And so any thoughts on, how we address the topic in places that aren't necessarily going to call it climate risk, but might call it environmental risk or otherwise?
Yeah, I mean, I think you have to be knowledgeable about where you're sitting and kind of what conversation is palatable at the local level, but not shy away from the fact that this is something that needs to be addressed. You're going to have these financial impacts depending on whether you call it one thing or another. And so what are you going to do in terms of kind of wrapping that up into kind of like, we understand what this risk is and what the impacts have been for us in the past, and here's our plan going forward to make sure that they're fine. And what we're hearing too is that the investor community is actually starting to really think about the climate projections piece. So how much worse could the climate get in that region or that area? And so if you're an issuer and you're not thinking about those things, that's going to be kind of a difference between what you're putting forth and what they're looking for. But I should say, the motivation shouldn't only be for positioning to investors. I mean, every capital investment at this point should be resilient. It should be or built to be resilient in the future. And as we're getting a clearer picture of some of the climate projections, now we can really start taking steps to internalize that information and see what it means for the different areas that any kind of local government has under its jurisdiction. I guess I'll stop there. I don't know if I quite answered the question, but I mean, I think that the idea is that this is something that has to be considered regardless of how exactly you're saying it.
Yeah, and I would offer the example from Vermont where this is more to do with acute risk, but the local FEMA match in the event of a declared disaster, the local match is reduced to the extent that a community has produced a hazard mitigation plan that's on file with the Department of Emergency Management. So, that's a clear cost to a state that, even folks that are climate shy aren't shy about asking for FEMA dollars. So one place where that can be integrated. There's an interesting question that came from the audience, and this gets to some of what Evan was talking about the E and the S being inextricably linked. But this question, audience member raises the prospect of the so-called black tax, which was identified in a paper on the municipal market that was presented last year. And so as we develop a new paradigm of risk analysis, how do we ensure that the inequities that are already in the bond market don't become even further exacerbated? Because as Evan described, those places are sometimes the places that are going to be feeling the impacts the most. So I suppose, Evan, any more thoughts on that? And, I think we can probably all share a turn.
Sure. So Erica led this paper on one of two papers that were published last year on this exact topic. So I would actually mostly defer to her to start on this. I certainly have opinions, but I'll follow any comments Erica has on this.
Yeah, so I really like this question, and it's, arguably, well, at least in my view, like probably one of the most important ones facing the municipal bond market, and that's that climate risks are not felt unevenly, or not felt evenly. So they are felt unevenly, sorry. So climate doesn't necessarily discriminate, but in terms of the ability to respond to that, obviously more wealth is going to lead to an individual community being able to pay for disaster mitigation, cleanup, resiliency measures, et cetera, and still maintain a high rating. In the municipal bond market, like I said earlier, climate risk is not being priced in. Certainly not when you look at the scale of the whole market. Maybe in some particular regions you might see slight changes, but not at scale of the whole market. But we did find that there is evidence of a black tax, meaning that even after accounting for bond rating and then socioeconomic variables such as median household income, that there is still a yield penalty for communities that have a greater percentage of Black residents. And there's been some other academics that have found very similar results, actually found a yield penalty higher than our results. I don't think the actual number really matters. I think the point is that there is an issue in the municipal bond market and in many markets associated with legacy racism, historic redlining. And when you couple that with intensified climate risk in an area like the Southeast, you have a situation where the moment climate risk is priced into the market, because it will be priced in at some point, then you kind of are getting hit twice, right? So you're paying more for capital on two accounts, and that brings up a lot of equity concerns. And I think that the market as a whole should care about that. Rating agencies should care about that. Obviously, nonprofits, governments should care about that, and individual communities should really care about that. And I don't know the solution to it. I don't think there's really time to get into that, but I do think it's a great question, and one that I hope that a lot of investors and market participants pay attention to.
Yeah, and I return to the bond bank concept. I think there's been some articles on this very subject, but it's a great equalizer. Here, our smallest community is getting the same rate. We don't risk rate our actual cost that we're giving to borrowers. So our smallest community is getting the same rate as our largest community. Our best credit is getting the same rate as our worst credit. And in all cases, the rate that they get is better than they could otherwise get by themselves. And so obviously we have a political environment where there's will to do that, but looking at a bond bank-like solution that's either regional, national, or otherwise supported through some other means is one way to address both these problems and gets at some of the scale issues we've been talking about. So we're just about out of time, but I wondered, is there I guess any parting thoughts as we just have a few minutes here, and keep in mind, maybe starting with Amy as we leave here.
Yeah, thank you. I just want to say that, especially in response to that last point, I think the thing that I'm heartened to see is that there is a lot more focus on proactive risk mitigation, and so getting ahead of things, and that will also help reduce how much a disaster might create more disparity. I think if we can really focus on that and doing that pre-disaster mitigation in an equitable way, we're going to be positioning ourselves for a better future. But I think all of this is changing quickly, and so it's an opportunity to really kind of wrap our heads around it and get ahead of the game if we can.
Yeah, I'll try to say one thing as succinctly as I can with a minute left or whatever. Again, just sort of on this idea of inequality and the black tax type question. If we take a step back and kind of look at the market from a systems level, and kind of think back to where we were looking at things like drought and heat stress, for example, and these aren't the only things we should be thinking about, but they're top of mind. When we look 20 to 30 years out, and I'm not saying that we have to wait for 20 to 30 years for these things to start to happen. When we get to a point where there are portions of the US that are functionally unlivable as they are right now, the first thing that's going to happen is going to be that's going to impact underserved communities in a sense that they won't have the capacity to deal with it from a access to market capital perspective, or from a healthy way of migrating, to a place that is livable. And so what seems to start out as, a nice, which might be perceived as sort of dealing with structural inequality, racial inequality, is sort of a nice to have or an impact investment type idea, is that eventually we could be facing a situation where all of this coalesces into, okay, we have millions of people that need a healthy place to live and work and thrive, and proactively issuers living in places, say in the American Midwest, that are facing less disasters could be thinking about proactively bringing in people to build diverse, thriving communities with jobs where people are, the renaissance of a place like Detroit, Cleveland, Minneapolis and getting ahead of this in a way that's equitable. And on the flip side, in terms of for everybody to think about this carefully from an investment point of view, there is a persistent prioritization of risk being framed as risk to the investor and not risk to the community. And I think that's something that everybody that works in the municipal market has a responsibility to think about really carefully.
So Erica, anything to add?
No, I think those points are great. And I guess I reiterate both of them. And one final thing I'll say is that obviously with some of the major things going on with large insurers pulling out of states in the US on account of climate risk, I think even though we're not seeing a climate risk pricing signal right now in the municipal bond market, it truly is only a matter of time.
Yeah, and I think we are out of time, but I can't help but adding my thoughts in that, some places are experiencing sort of, well, like Vermont in particular, post-COVID sort of upside risks of climate change. We see people coming here, purchasing fairly nice places, have fairly high income, and that migration has been a positive net effect in some ways, although it does contribute to a housing crunch. But migration certainly can be very destabilizing, as we see internationally. And that's another, I think, point to think about in terms of adding on to Evan's thoughts and why it's important to invest in those places and overcome those inequities that are historic. So with that in mind, thank you so much for everyone for joining us here for this hour and 2 minutes. And thank you to C2ES for jointly hosting this with the Bond Bank. And look forward to talking with everybody in the future. Take care.